Hey guys, welcome back to the channel. Today I wanted to go through a couple of the robo-advisors that I've been investing in. Um, Now, I've mostly been giving these a try just to see how they are. And we're not quite at the end of Q1, but given sort of the market volatility in this year, I thought it was actually a really good time to check in and see what each of these different robo advisors offers. And by looking at sort of like how the markets have been, we can see sort of how they manage their diversification. Because each of them approaches it in a different way. And based on sort of the current time period that we're in, year to date, I think it's sort of a good example of how each of these portfolios performs during sort of like up and down periods. So overall, the markets have been pretty volatile this year. US equity markets are down. So the S&P 500 is down overall for the year. Whereas, some international markets, looking at sort of like the global ex-US market, it's up. So, looking at the past 2 years where the S&P 500 has been just, doing really, really well. Now we're in a period where it's slowed down or had some sort of pullback. So the three robo-advisors that I'm going to be comparing right now are ones that I've talked about in separate videos. So one is Schwab's Intelligent Portfolio. The next one is Vanguard's Digital Advisor. And the last one is SoFi's Robo-Advisor. So these three different portfolios are automatically rebalanced for you. They invest you in a variety of different ETFs. So on the whole, from sort of like a 50,000 foot view, they all basically do the same thing. They do seek diversification by allocating you to at least a couple different ETFs. And each of these ETFs obviously has a basket of stocks, so you're diversified among many different companies. But as we'll see by looking at each of them and their performance over the last few months, each of them takes a different approach to what diversification means. So the first one I want to talk about is the Schwab Intelligent Portfolio. Now, I've really liked this portfolio. Obviously, it does come with some drawbacks, which I've talked about in one of the videos that I made. The great thing about this portfolio is that it doesn't charge you an advisory fee, but it does hold a high amount of cash, which, in a volatile period or a down market isn't a bad thing. But they say that they do that to sort of like be strategic and opportunistic. But if we look at sort of the return for the portfolio from the beginning of the year, we'll see that I have right now, as of March 20th, a rate of return of 1.46%, positive 1.46%, which is important to know because the S&P in that same period is down 3.22%. So we're outperforming the S&P 500. Obviously, like that probably wouldn't have been the case last year because the S&P 500 did so well. But this year, given sort of the downturn in the market, it's actually protected our portfolio. And so the reason that it has protected our portfolio is because we have international stocks in this. So if we look at sort of like the positions of the portfolio, we can just see that it's not all concentrated in the US market, which we will see in other portfolios. So, over this period, we can see that like certain stocks are up. We have an international fund. We have a good amount international, actually. There's an international small cap. There's just a broad international equity fund. There's an emerging markets fund. So really, we're getting a lot of diversification outside of the US in this portfolio, while still maintaining like a healthy portion in the US as well. So we can also see that we have real estate. We have, other sort of diversification buckets in here as well that we won't always get in other portfolios. But the key sort of thing to know here is that the Schwab portfolio tends to give a higher priority to international equities than perhaps other robo-advisors. So on the whole, the Schwab portfolio, as we've seen, invests in a decent amount of US equities, but it still maintains like a pretty healthy portion of the portfolio in international equities, including international real estate. So, this is a moment, as in this current year 2025, like this is a moment to like really think about what diversification does for you. And there are a lot of people who have been arguing that you should all be in all the US market right now because US equities are just so strong. But this is a moment where we really can look and see that international equities really help protect us when the US markets turn down, because they're not 100% correlated. So the idea that you're all concentrated in the US market might not be the best idea when there's a downturn. The next portfolio we'll look at is the Vanguard Digital Advisor. And year to date, this portfolio is up 1.76%. Again, that's compared to the minus 3.22% of the S&P 500. So we're doing really well in this portfolio. There's not really that much to say about Vanguard's Digital Advisor because it's a very simple allocation. The holdings are very simple. They invest in two different ETFs that are very low cost. They invest in a US equity and an international equity ETF. So the main US equity ETF that they invest in is VTI, which is a broad market ETF, even broader, I think, than the S&P 500. And then the international ETF is VEU, which is their FTSE All World ex-US ETF. And they really do kind of almost split it evenly. There's a bit more of US equity. I would say it looks like like about 44% international versus 57% US equities. So really it's kind of like pretty split down the middle. Not such a high weight for US equities. Like a lot of times, like you'll see people put a lot of money and only a small portion into international equities. So it's really taking sort of like a global approach. And again, this has helped protect the portfolio during this downturn. There's been a market correction in the S&P 500 because, it's been sort of doing so well over the last couple of years, and sort of there's been a pullback. Obviously, there's a lot of like geopolitical stuff that's happening that's sort of called into question how the U.S. economy is going to be. But looking at Vanguard, I think what's really good about Vanguard, obviously they do charge, I think it's a 0.15% annual advisory fee, which is lower than most 0.25% advisory fees. But on the whole, what I would say about Vanguard, and I've said this before, is like it's a very simple, low cost way to achieve diversification to ETFs. I mean, you can do this on your own. You don't have to pay Vanguard the 0.15%. You can literally buy these two ETFs, VEU and VTI, and it will be a good diversified portfolio, truly, because you're holding a ton of stocks underneath each of those. So I would say the benefits of Vanguard is it's just very simple. It takes a very simple approach. Underlying the funds, when comparing Vanguard and Schwab just has higher expense ratios on their ETFs. Vanguard's very economical when it comes to like what they charge as far as expense ratios. So on the whole, like that just adds up to more performance. So while I will say that the Schwab portfolio feels a bit more diversified in the sense that like it has a lot of funds that it invests in, you're getting a lot of that underlying each of the two funds in Vanguard. So questionable whether you're actually getting more diversification or whether it's just sort of like because you have more funds, it seems like you're getting more diversification with Schwab. Lastly, I'm going to talk about SoFi's investor. And I will say that I've probably been the most disappointed with SoFi. And you'll see that, year to date, the portfolio is down by less than the S&P 500. So it's down minus 1.79% year to date, where again, the S&P 500 is down over 3%. So there's a bit of protection that happened, but not anywhere near Schwab or Vanguard's, because when you look at their holdings of SoFi, you see that they really, really prioritize the US market. So you're doubling up on a lot of stuff. So it seems like you're getting diversification, but really you're like owning the S&P 500 and you're owning an S&P 500 growth and an S&P 500 value. So you're really just doubling up on a lot of the companies that are already underlying some of these ETFs. And on top of that, they invest in sort of like active funds that are in the US market. The only two funds that they have that are not US based are both Vanguard funds. It's the developed market ETF and then the emerging markets ETF. And so, and they only really allocate a small portion of the portfolio to that. And you can see based on the performance that it didn't really protect us as much as we wanted it to during this downturn. And again, a big sort of con of SoFi is that they do charge you 0.25%. And so that's eating away at your performance on an annual basis. So, again, between sort of going all US equity markets and having like a very diversified portfolio with global equities, like the SoFi Robo Advisor lies somewhere in the middle because it's really concentrated in the US market, even though it has like a little bit of global equities. I would argue that on the whole, SoFi would be better off adding more international equities to their portfolio if it's a truly diversified global portfolio. But they've really prioritized the US equity market. And on the whole, it hasn't done as well over the year-to-date period. And I've been invested both in the Vanguard and the SoFi for about a year, or no, not maybe quite a year, but about the same amount of time. And the Vanguard portfolio has outperformed the SoFi portfolio. Of course, this is during a time when sort of US equity markets have pulled back. So this could have been a different story had I invested in them sort of 2 years ago or a year ago even, and was talking by the end of last year. So, on the whole, I still go with Vanguard because they're super cheap. You get diversification without any bells and whistles. And while I do like Schwab's intelligent portfolio, you're sort of like weighing the cost of the ETFs that they put you in. I just always think that, when they're not charging you an advisory fee, they're going to be putting you into ETFs where they can make money. And of course, they're not as competitive as Vanguard. And also they hold a good deal amount of cash. So, I would just say like, out of these three, my recommendation has been Vanguard, and I still continue to recommend Vanguard. But the Schwab portfolio again is also pretty good, and putting money in there will get you a very globally diversified fund. So yeah, this is just a check-in, sort of like as Q1 of 2025 sort of ends, and we've seen a lot of volatility in the markets. It's just a reminder that your portfolio should have global equities in them. That will help you diversify, and it really gives you a chance also to rebalance. So, this is a time to be thinking like, okay, have US equities sort of pulled back enough? Should I put more into them? Or have they grown, growing so much over the past couple of years that I should be putting more into global equities? Remember your target allocations and then always try to rebalance back to those. I hope you found this helpful. I know there's a lot of robo-advisors out there, and I've only tried a couple of them. But hopefully this helps you in sort of determining what to look for when you're sort of evaluating potential investments.